China is refusing to negotiate with President Trump on U.S. tariffs. In fact, the nation is taking the trade war to a new height.
Yeah, President Trump now saying, though, he's willing to lower levies on China while repeating that any trade deal would need to be fair.
The announcement of sweeping tariffs by newly elected U.S. President Donald Trump marked a sharp and controversial turning point in global trade policy. Almost immediately after his inauguration, President Trump implemented a series of aggressive trade measures aimed at addressing what he described as long-standing imbalances in trade between the United States and its global partners. Among these measures were tariffs that significantly impacted China, one of the United States' largest trading partners. In a move that sent shockwaves through global markets, China responded by canceling $690 billion worth of U.S. imports. This action triggered an economic and geopolitical ripple effect with profound implications across industries, nations, and international relations. Before we start, smash the like and subscribe buttons for more updates. At the heart of this dramatic shift was President Trump's trade philosophy rooted in a staunchly protectionist stance. His administration viewed trade deficits as a sign of economic vulnerability and unfair practice, and it sought to reverse decades of globalization by imposing tariffs designed to favor domestic manufacturing. China, as the United States' largest source of imported goods, became a central target of this strategy. The decision to implement tariffs on Chinese goods was not entirely unexpected given Trump's campaign rhetoric, but the speed and scale with which the tariffs were introduced stunned many in the international community. China's cancellation of $690 billion in U.S. imports was not merely a tit-for-tat retaliation, it was a calculated and multifaceted maneuver. It aimed not only to impose economic pain on the United States, but also to signal to the world that China was prepared to assert its economic sovereignty. The cancellation included a broad range of American products: agricultural goods, energy exports, technology, automobiles, and even some pharmaceuticals. Each of these sectors stood to lose significantly from the loss of access to the Chinese market, which had become deeply intertwined with American business models and supply chains over decades of liberalized trade. For American farmers, the impact was immediate and brutal. China had been a major buyer of soybeans, corn, pork, and other agricultural commodities. Without Chinese demand, prices for these goods plummeted, leaving farmers facing unsold inventory and mounting debts. Rural communities across the United States, many of which had voted for Trump with hopes of economic revitalization, found themselves grappling with the consequences of a trade war they hadn't anticipated in such stark terms. The sudden disappearance of their largest customer created an economic vacuum that domestic markets could not fill. In the manufacturing sector, the shock was twofold. Many American manufacturers relied on Chinese demand to sustain their production levels and profits. The cancellation of orders meant slashing production, laying off workers, and reevaluating strategic operations. Furthermore, manufacturers were hit by increased costs due to tariffs on imported Chinese components, creating a vicious cycle of reduced profitability and declining competitiveness. For companies with intricate global supply chains, the tariffs and subsequent Chinese withdrawal upended long-established logistics and business models. Adjusting to this new reality required time, capital, and strategic overhauls that few companies were prepared to undertake on such short notice. Energy exports also took a significant hit. The United States had become a key exporter of liquefied natural gas, LNG, and crude oil to China. The cancellation of these energy deals not only affected revenues for American energy producers, but also complicated the strategic calculus of energy diplomacy. American energy firms had invested heavily in infrastructure and logistics to meet Chinese demand. With those plans now in disarray, the industry faced excess capacity and strained relations with investors and stakeholders who had counted on continued growth in the Asian market. Beyond the immediate economic impacts, the cancellation signaled a deeper strategic decoupling between the two economic superpowers. For years, economists and policymakers had debated the resilience and risks of the U.S.-China economic relationship. This abrupt rupture offered a real-time case study in what economic disentanglement might look like. The move raised questions about the long-term viability of globalization as it had been practiced in the post-Cold War era. suggesting that a new era of economic nationalism and bilateral power politics might be taking shape. Global markets reacted with extreme volatility. Investors, already wary of President Trump's unpredictable policy style, found themselves navigating uncharted territory. Stock indices dropped, particularly those with heavy exposure to international trade and export-driven companies. Currency markets were jolted as the yuan slid in anticipation of economic turbulence in China, while the dollar fluctuated amid uncertainty about U.S. economic resilience. Commodities like soybeans, copper, and crude oil saw massive price swings, reflecting the sudden vacuum in trade flows between the two largest economies. Internationally, the cancellation reverberated through the global economy. U.S. allies and competitors alike were forced to reassess their trade strategies. Countries that had traditionally depended on a stable U.S.-China trade axis found themselves facing unpredictable conditions. Supply chains that had crisscrossed the Pacific were now caught in a maelstrom of uncertainty, with businesses scrambling to find alternative suppliers and markets. Meanwhile, other global powers, particularly in Europe and Southeast Asia, saw opportunities to fill the void left by the U.S. in the Chinese market. European agricultural exporters, for example, quickly moved to offer alternatives to Chinese buyers who were suddenly shut out of the U.S. market. The cancellation also had significant political consequences within both nations. In the United States, Trump's move was met with a mixture of support and backlash. His base largely applauded the action as a demonstration of strength and a long overdue stand against what they perceived as exploitative foreign trade practices. However, the economic fallout began to stir dissent, particularly in states and industries hit hardest by the Chinese pullback. Lawmakers representing agricultural and manufacturing regions voiced concern over the sustainability of the administration's strategy. As business confidence waned, so too did the political unity within Trump's coalition. In China, the decision to cancel U.S. imports was also laden with political symbolism. It demonstrated the Chinese government's willingness to absorb short-term economic pain in service of long-term strategic goals. The move was framed domestically as an assertion of sovereignty and national dignity, reinforcing the narrative that China would not be bullied or coerced by foreign powers. The Chinese leadership used the moment to promote self-reliance, accelerate investments in domestic innovation, and deepen ties with other emerging economies through initiatives like the Belt and Road. This dramatic shift in U.S.-China economic relations also prompted a reassessment of global trade institutions. Organizations like the World Trade Organization found themselves sidelined as bilateral confrontation took precedence over multilateral negotiation. The weakening of these institutions highlighted the fragility of the post-World War II global economic order, which had relied on consensus building and legal frameworks to manage disputes. The U.S.-China standoff revealed that when major powers decide to act unilaterally, the traditional tools of global governance may offer limited recourse. Financial analysts and economists began to model potential long-term scenarios stemming from the cancellation. One possibility was the fragmentation of global trade into competing blocs, with the U.S. and China each forming their own networks of economic allies. This kind of bifurcation would have deep implications for everything from supply chains to innovation ecosystems. Another concern was the impact on developing nations, many of which depended on trade with both the U.S. and China for growth. These countries risked becoming collateral damage in a conflict they had little power to influence. Technological industries were especially vulnerable. Semiconductors, telecommunications equipment, and other high-tech goods were at the center of the economic battlefield. The cancellation of imports affected joint ventures, research collaborations, and technology licensing agreements that had previously flourished between the two nations. American tech companies found themselves cut off from one of their most important markets, while Chinese firms accelerated their push for indigenous innovation to reduce dependence on foreign technology. This development fed into a broader technological arms race, with both sides investing heavily in AI, 5G, and quantum computing to assert dominance in the coming decades. Amid this turmoil, the role of multinational corporations came under intense scrutiny. Many of these companies had spent decades building complex transnational operations that leveraged global efficiencies. Suddenly, these strategies were being tested against a backdrop of political hostility and economic nationalism. Some companies attempted to hedge their risks by diversifying their supply chains away from China or by investing in domestic capacity, but these transitions were neither easy nor inexpensive. The underlying question became whether the globalized business model was still viable in a world increasingly defined by national interests and geopolitical rivalry. The educational and cultural exchanges that had once served as a soft bridge between the two nations also began to suffer. With economic ties fraying, programs that facilitated academic collaboration, business internships, and cross-cultural understanding began to diminish. The tone between the two nations grew sharper, with suspicion replacing cooperation. Economic decoupling, it appeared, was feeding into broader social and diplomatic estrangement. The implications of China's cancellation of $690 billion in U.S. imports extended well beyond spreadsheets and stock prices. It marked the emergence of a new world in which economic power was wielded more aggressively and where the assumption of mutual dependence no longer guaranteed stability. The trade policies initiated by President Trump catalyzed a global reckoning, forcing governments, corporations, and citizens to rethink how they engage in commerce, diplomacy, and strategic planning. This moment would not soon be forgotten. It was the day two giants took a step back from each other, reshaping the balance of global economic power in ways that would reverberate for decades to come. Would you like a visual timeline or chart summarizing key events in this trade confrontation? While the immediate effects of China's cancellation of $690 billion in U.S. imports were startling, the broader systemic changes it initiated began to unfold more subtly in the months that followed. Though no aftermath is to be discussed, the structural shifts put into motion during this phase of the event deserve detailed exploration. These shifts went beyond economics, infiltrating legal structures, regulatory approaches, labor patterns, and corporate governance norms, each driven by the abrupt dislocation of what had been the world's most consequential trade relationship. One of the most profound effects was the reorientation of domestic industrial policies within both nations. In the United States, the Trump administration's tariffs had already indicated a commitment to reshoring jobs and manufacturing capabilities, but China's response added urgency to that aim. To navigate the sudden shortfall in exports, U.S. industries began lobbying more aggressively for federal support to bridge the gap caused by the loss of Chinese demand. This included increased calls for subsidies, tax incentives, and deregulation to keep operations afloat. The government, in response, faced mounting pressure to not just protect industry through tariffs, but to actively fund and steer its direction. A form of neo-industrialism began to emerge, with policymakers taking a more hands-on role in determining which sectors would receive financial lifelines and which would be left to weather the storm unaided. The legal implications of the cancellation also began surfacing in more granular areas. Contract law became a battlefield as businesses grappled with the sudden void in long-term trade agreements. U.S. companies with legally binding export contracts to Chinese firms found themselves in complex disputes. Some tried to enforce clauses related to force majeure or breach, while others sought compensation through international arbitration courts. Legal institutions, both domestic and global, were flooded with cases examining whether tariffs and state policies constituted justifiable grounds for contract termination. This legal gridlock slowed economic recalibration and burdened courts with complex cases involving cross-border jurisprudence. As legal uncertainties grew, so did changes in the regulatory landscape. Government agencies were compelled to reinterpret or rewrite trade compliance rules to align with the new reality. The Office of the United States Trade Representative, the Department of Commerce, and Customs and Border Protection began issuing new guidance to address re-export strategies, country of origin labeling, and new countermeasure protocols for retaliatory actions by other nations. These shifts required companies to overhaul internal compliance systems, introducing an additional layer of cost and complexity at a time when they were already operating under significant strain. Meanwhile, American labor markets began to evolve in anticipation of a broader shift in industrial focus. Training programs were rapidly redesigned to move workers away from export-heavy roles, especially those in agricultural processing, port logistics, and manufacturing tied to Chinese consumption. Public and private education institutions received renewed funding to emphasize technical skills in electronics assembly, additive manufacturing, and domestic supply chain management. This retraining movement was not simply a response to job losses, but an attempt to redefine what American competitiveness would look like in a world where access to Chinese demand was no longer guaranteed. In China, the withdrawal from U.S. imports also initiated a rapid expansion of alternative sourcing strategies. The Chinese government activated procurement networks in regions such as Latin America, Africa, Southeast Asia, and Central Asia to replace the goods it had previously sourced from the United States. Bilateral agreements were swiftly signed to secure agricultural commodities, energy supplies, and high-tech components. In many cases, these new suppliers were not equipped to deliver at the scale or quality China was accustomed to, necessitating massive infrastructure investments, knowledge transfers, and logistics overhauls. These new trade corridors were not just economic adaptations, they became strategic instruments for China's global positioning. By reallocating its import portfolio to include more developing nations, China extended its sphere of influence and built a web of economic dependence. Countries that stepped in to supply China found themselves negotiating from weaker positions, often accepting asymmetric terms in exchange for access to Chinese capital and markets. This power imbalance effectively gave China more leverage over these nations, enabling it to assert itself not just as a buyer, but as a political and regulatory trendsetter. China's internal economic architecture also underwent modifications. The abrupt removal of American imports compelled a revitalization of domestic production capacity in areas where China had been reliant on U.S. expertise or goods. This was particularly visible in biotechnology, aerospace components, and agri-tech machinery. The state initiated special economic zones focused on replacing these dependencies, coupled with state-subsidized research and development efforts. Chinese universities and public-private research consortia were mobilized with renewed purpose to create homegrown innovations that could substitute what was previously imported from American firms. Within both nations, consumer behavior began to shift in subtle but measurable ways. In the United States, products that were once abundant and affordable due to Chinese imports became more expensive, forcing changes in consumption patterns. Retailers scrambled to find alternative sourcing countries for textiles, electronics, and household goods. Consumers, in turn, grew more cost-sensitive and began adjusting their spending toward necessities, locally produced goods, or lower-tier substitutes. This consumer transition began reshaping domestic retail landscapes, empowering small manufacturers while eroding the dominance of big-box stores that had built their empires on Chinese supply chains. In China, the cancellation meant a corresponding increase in the presence of non-American brands, particularly European and domestic alternatives. American cultural exports, ranging from fashion to tech gadgets, saw their market share shrink, replaced by Chinese equivalents or products from regions less affected by the trade dispute. This realignment deepened consumer nationalism, as government propaganda encouraged "Buy Chinese" campaigns and praised local ingenuity. A sense of pride was infused into everyday purchasing decisions, converting shopping behavior into acts of economic patriotism. The cancellation also impacted the financial sector. In the U.S., financial institutions began reassessing credit risk models, especially for sectors heavily reliant on Chinese demand. This led to a tightening of lending conditions for exporters and manufacturers who could no longer demonstrate market stability. Insurance premiums on trade shipments rose sharply as uncertainty over contract enforcement and geopolitical risk became embedded in financial calculations. The derivatives markets began developing new instruments to hedge against geopolitical shocks, underscoring how deeply intertwined international finance had become with political decision-making. Investment flows began to shift in both direction and purpose. American venture capital and private equity firms scaled back their activities in Chinese markets, redirecting funds to domestic startups with minimal overseas exposure. Meanwhile, Chinese outbound investment toward the U.S. dried up almost overnight. This led to the decline of major real estate deals, tech partnerships, and infrastructure investments that had once symbolized economic interdependence. What followed was a reallocation of capital toward friendlier jurisdictions, or alternatively, into state-sponsored Chinese development projects aimed at fostering self-reliance. The educational sector also felt the impact. With trade ties severed, student exchanges, research grants, and academic partnerships between the two nations saw a dramatic decline. Universities that had built programs around bilateral collaboration found themselves scrambling to reconfigure their offerings. Chinese students, who once viewed American institutions as the pinnacle of academic prestige, began redirecting their ambitions toward European or domestic universities. American universities, for their part, experienced financial shortfalls due to declining international enrollment, particularly in STEM fields. These changes began to shift the global distribution of academic talent and intellectual capital. Media narratives within each country grew more polarized and nationalistic. In the United States, mainstream and alternative outlets portrayed China's cancellation as either an act of aggression or a necessary wake-up call, depending on political orientation. In China, state-controlled media emphasized American unreliability and celebrated domestic resilience. The result was an information environment in which mutual understanding eroded, replaced by caricatures and ideological entrenchment. Public perception on both sides hardened, making any future reconciliation efforts more politically costly and complex. Civic institutions and non-governmental organizations that had previously worked across the US-China divide began to reassess their missions. Foundations and think tanks focused on cooperation shifted gears or shut down entirely, unable to sustain their mandates in an atmosphere of antagonism. Environmental groups, for instance, found it harder to coordinate cross-border action on climate issues, as diplomatic channels narrowed and national priorities took precedence over global imperatives. Even the cultural sphere, often the last bastion of diplomacy in times of economic or military tension, was not immune. Joint film ventures were canceled, art exhibitions postponed, and collaborative projects dissolved. Visa restrictions began to affect artists, athletes, and performers, cutting short the informal people-to-people diplomacy that had long helped maintain a sense of shared humanity between the two nations. As cultural bridges collapsed, the symbolic separation grew more pronounced, making future rebuilding efforts more daunting. Technology ecosystems experienced an accelerated divergence. American firms began building more secure, self-contained tech stacks to insulate against supply disruptions, cyber vulnerabilities, and intellectual property theft. Chinese companies mirrored this behavior by developing parallel ecosystems, from operating systems to digital payment platforms. The long-imagined Splinternet, a world with parallel digital environments governed by competing standards, became a tangible reality. As this technological divergence took root, it not only reshaped user experience but also redefined norms around data privacy, AI ethics, and cybersecurity. The military-industrial implications of the trade rupture were also significant. Without being entangled in the logistics of a functioning trade relationship, military planners on both sides gained freer rein to pursue scenarios of strategic competition. Defense contractors noted an uptick in procurement requests tied to contingency planning for Pacific-based scenarios. Military supply chains were reevaluated to minimize reliance on Chinese materials, and wargaming exercises began to incorporate economic conflict as a precursor to more overt confrontations. While war was never an immediate outcome, the conditions for strategic mistrust had undeniably deepened. Even real estate markets saw unusual distortions. In the United States, major urban centers that had become accustomed to Chinese capital inflows, especially in commercial and luxury real estate, experienced sudden cooling. Real estate developers reliant on Chinese financing began to miss deadlines and default on obligations. In China, large conglomerates that had invested in U.S. real estate rechanneled those funds into domestic megaprojects, reshaping urban development priorities at home. As the cancellation unfolded, it laid bare the extent to which the world's two largest economies had become interwoven at every level, from the granular texture of daily consumer purchases to the structural integrity of global capital markets. The uncoupling triggered not only a rupture in trade, but a recalibration of norms, expectations, and geopolitical alignments. It forced businesses to confront long-ignored vulnerabilities, compelled governments to redefine economic strategy, and reshaped public perception in ways that would influence generations to come. Would you like a detailed map showing sector-by-sector breakdowns of how the cancellation affected different industries in both countries? The severance of $690 billion in U.S. imports by China after President Donald Trump's tariff declarations catalyzed a wave of global change that extended well beyond bilateral tensions. The event operated not only as a transactional rejection of American goods, but also as a statement that shifted strategic power dynamics, altered institutional behavior, and led to widespread economic realignment. It created not only gaps, but new avenues, forcing global actors to pivot, recalibrate, and at times completely redefine their role in the global economic structure. This act wasn't simply an economic reaction, it was a geopolitical maneuver with sweeping implications. Within these regional alliances, infrastructure took on strategic importance. Ports, roads, railways, and digital infrastructure began receiving new funding from governments and private investors aiming to reroute the traditional arteries of commerce. Countries previously overshadowed in global trade, like Kazakhstan, Kenya, or Colombia, became logistics hubs and transshipment points as new patterns of commerce emerged. This redistribution of trade routes injected dynamism into economies that had long played peripheral roles, ushering in localized industrialization efforts and incentivizing technology adoption to support expanded commercial capacity. Currency dynamics also began to shift rapidly. The dominance of the US dollar, which had long underpinned international trade and reserves, came under more sustained scrutiny following the rupture. With China refusing to purchase American goods at such a massive scale, the demand for US dollars in certain global markets diminished. In response, a cohort of countries began exploring alternatives for transaction settlement, including increased use of the euro, yen, and particularly the Chinese yuan. Central banks in emerging economies started diversifying their reserves, shifting portions of their holdings away from U.S. Treasury securities toward gold, cryptocurrencies, and regional assets. This slow but consequential shift threatened to erode the financial supremacy that had given the U.S. unmatched leverage in global economic governance. Cryptocurrencies experienced a parallel surge in adoption. With traditional trading systems destabilized and trust eroding between nations, decentralized digital currencies offered an apolitical, programmable alternative. Nations suffering collateral damage from the trade war, including those under U.S. sanctions or lacking stable financial institutions, turned to blockchain-based solutions for cross-border settlements and trade financing. Stablecoins pegged to baskets of goods or commodities gained credibility as a hedge against political volatility in fiat-backed systems. This push toward decentralized finance began laying the foundation for a more fragmented yet resilient financial ecosystem. Corporate governance across industries was forced to evolve. In response to the unpredictability of cross-border regulatory environments, companies began installing geopolitical risk officers alongside financial and compliance executives. The responsibilities of corporate boards expanded to include scenario planning for events like economic sanctions, border shutdowns, and the cancellation of government contracts due to international pressure. The concept of fiduciary duty started to stretch, incorporating not just the maximization of shareholder value, but also resilience planning and national alignment. Supply chain architecture underwent an equally profound transformation. No longer were efficiency and cost saving the sole criteria for decision-making. Resilience, redundancy, and nearshoring became key priorities. Enterprises began adopting China Plus One or America Plus regional models, where reliance on any one country was deemed too risky. This prompted the adoption of cutting-edge digital twin technologies that allowed companies to simulate various supply chain configurations and stress test them against different geopolitical events. Artificial intelligence and machine learning models became standard tools in supply chain logistics, offering predictive insight into disruptions and optimization suggestions for contingency scenarios. Technology governance frameworks started diverging at an accelerated pace. China ramped up efforts to entrench its standards in telecommunications, data governance, and AI ethics across its new trade partners. Simultaneously, US-aligned nations began forming their own consortia to define technological frameworks that aligned with liberal democratic norms. These dual systems began influencing global governance structures, prompting the emergence of competing global standards for digital infrastructure. International organizations that once played a neutral role in setting technical standards found themselves increasingly politicized, caught between the two major power blocs. The environmental impact of this trade fracture also proved to be significant and multifaceted. On one hand, reduced shipping volume between the US and China briefly lowered transoceanic freight emissions. However, the emergence of less efficient trade routes and the establishment of redundant supply lines increased emissions elsewhere. Additionally, with trade tensions taking center stage, environmental cooperation between the two powers, the largest global emitters, stalled. This affected climate negotiations and reduced the efficacy of multilateral agreements where US-China collaboration had previously been pivotal. The global push toward a sustainable future encountered a complex barrier as economic nationalism began conflicting with environmental multilateralism. If you like this video, please give it a like and subscribe to our channel. Also, leave your comments below and tell us, what are your thoughts on China canceling $690 billion in US imports? We want to hear from you. Thank you for watching and see you next time.